The S&P 500 closed last Friday at an all-time high. That same day, Goldman Sachs raised its Brent crude forecast to $90 a barrel through year-end, nearly $30 above where it stood before the Iran war began. Both of those things are true simultaneously, and that tension is exactly what this week is built on. The Strait of Hormuz has been functionally closed for 9 weeks. Daily transits through the choke point have fallen to near zero. That means roughly 14.5 million barrels of Persian Gulf production are offline every day, according to Goldman's April 27th note. Brent settled near $108 Monday. West Texas Intermediate crossed 96. The International Energy Agency has called this the biggest supply shock in recorded history, a loss of 1 billion barrels already locked in, more than double the emergency reserves governments have released since fighting started in late February. Here is the mechanism the market is trying to price. Higher oil means higher fuel costs. Higher fuel costs feed into transportation, manufacturing, and food prices. That pathway, crude to consumer prices, is already visible in the data. Producer input costs are rising globally as Iran war supply chain disruptions ripple through factory orders. If Brent stays at these levels through summer, inflation pressures will force every major central bank to hold rates longer than markets have been pricing. That is where the Federal Reserve enters. The FOMC meets Wednesday. No rate move is expected. The CME Fed Watch tool is priced the next cut for late 2027, pushed back from 2 cuts forecast in early 2026. And this meeting carries additional weight. It is almost certainly Jerome Powell's last press conference as Fed chair. Kevin Warsh's Senate confirmation is expected to coincide with Wednesday's vote, with Powell's term ending May 15th. Warsh has called for a regime change at the Fed, including eliminating the dot plot and shrinking the balance sheet. Markets are uncertain whether that means dovish flexibility or tighter discipline, and that ambiguity is itself a drag. KPMG's chief economist said recently there is not one clear path ahead, with some Fed officials internally weighing a hike as well as a cut. The peace talks remain the key conditional. Trump canceled the second round of U.S.-Iran negotiations on Saturday, and Iran's foreign minister said Tehran won't negotiate under threat or blockade. If talks restart and Hormuz normalizes before June, Goldman's current base case, the inflation risk fades and the rate path could shift back toward cuts in late 2026. If the strait stays closed through summer, every upward revision to oil forecasts feeds directly into the Fed's calculus, and the window for rate cuts in this cycle may close entirely.
Wednesday night, the 4 largest cloud operators on Earth, Alphabet, Amazon, Microsoft, and Meta, report earnings in the same aftermarket window. Apple follows Thursday. Combined, these 5 companies represent roughly $16 trillion in market value. That is approximately 1/4 of the entire S&P 500. Roughly a third of the index by weight now lives or dies on the quarterly results of 7 companies, a concentration that has nearly tripled over the past decade. The rally that pulled the S&P 500 back from its late March lows has been almost entirely their work. Alphabet, Amazon, Nvidia, and Meta are each up more than 25% from the bottom over the past 4 weeks, according to Bloomberg. The Magnificent Seven's first quarter earnings are projected to grow 19% year over year versus 12% for the rest of the index. That gap is the entire justification for the premium. This week's reports are where justification becomes evidence, or doesn't. The single number every portfolio manager is watching is cloud growth acceleration. Azure, AWS, and Google Cloud are each expected to show higher growth rates this quarter than last. For Microsoft, the Intelligent Cloud segment, which houses Azure, is projected at 28.5% year-over-year growth, a slight acceleration from 28% last period. Management attributed previous stagnation to capacity constraints, not demand weakness. If capacity has caught up, the number moves. If it hasn't, the explanation wears thin. For Alphabet, Google Cloud revenue is projected at $18.4 billion for the quarter, a 50% year-over-year increase. The stock is up 30% over the past 6 months, making it the outperformer of the hyperscaler group. Alphabet also just secured a Pentagon contract to deploy its Gemini AI across Defense Department systems, adding a government revenue channel that competitors are now scrambling to replicate. The earnings print will test whether that optimism has been priced correctly. The tension reset sits in capital expenditure. Combined capex from Microsoft, Alphabet, Amazon, and Meta is projected to reach $649 billion for full year 2026, up from $411 billion in 2025. That spending rate is roughly what the U.S. government pays for Medicare in a year. Every dollar of that is a bet that AI demand scales fast enough to generate returns before the bills come due. When Microsoft reported in January and capex hit $37.5 billion in 1 quarter, the stock sold off. The rally since then has priced in a recovery. If Wednesday's capex guidance pushes higher again without a corresponding acceleration in cloud revenue, the market faces the same anxiety it thought it had left behind. The verification benchmark is simple. Azure growth above 29% clears the bar for acceleration and supports the bull case. A miss or a hold at 28% puts the entire Magnificent 7 premium back under scrutiny, at the worst possible moment, with oil risk still unresolved in the background.
The same Monday that jury selection began in the Musk versus Altman trial in Oakland, Microsoft and OpenAI announced they were ending their exclusive partnership. The timing was not coincidental. It was a signal about who currently holds leverage in the AI ecosystem, and the answer is not Microsoft. Under the original terms built since 2019, OpenAI ran exclusively on Microsoft's Azure cloud, and Microsoft held exclusive licensing rights to OpenAI's intellectual property until the company reached artificial general intelligence. That arrangement made Microsoft the mandatory gateway for enterprise access to ChatGPT and GPT-4. Monday's amended agreement removes both exclusions. OpenAI can now serve all of its products through any cloud provider, including Amazon Web Services and Google Cloud. Microsoft's license to OpenAI's IP extends through 2032, but it is no longer exclusive. The direct market reaction told the story. Microsoft shares fell roughly 1%. Alphabet and Amazon held or gained. Microsoft has lost about 20% of its value over the past 6 months. Alphabet is up 30%. Amazon is up roughly 17%. The spread captures what investors are pricing. The AI-driven cloud advantage that Microsoft built through its exclusive relationship with OpenAI is now available to competitors. The mechanism runs deeper than cloud routing. OpenAI will continue paying Microsoft a revenue share, fixed at 20% through 2030, but Microsoft will no longer receive revenue from OpenAI's customers routed through Azure on the same terms. Amazon CEO Andy Jassy confirmed Monday that OpenAI models will be available directly through AWS's Bedrock service within weeks. That means enterprises now have a genuine multi-cloud option for OpenAI integration, removing the lock-in that previously made Azure the default. This reconfiguration lands directly on Microsoft's most vulnerable point heading into Wednesday's earnings. Analysts are watching whether Azure can clear the acceleration threshold, while the company simultaneously loses its structural moat over OpenAI distribution. Salesforce has also filed an antitrust lawsuit against Microsoft in the UK over Teams bundling, adding regulatory pressure. The SaaS sector, where companies like Salesforce and ServiceNow are down 31% year to date, is pricing the fear that AI labs will eventually displace enterprise software vendors entirely. The Musk versus Altman trial adds a conditional overlay. Musk is seeking to unwind OpenAI's inversion from nonprofit to public benefit corporation and oust Altman. The case is expected to run 4 weeks, with Altman, Musk, and Microsoft Satya Nadella all scheduled to testify. A ruling in Musk's favor, considered unlikely by most legal analysts, with Kalshi Prediction Markets pricing his odds at 45%, would destabilize OpenAI's governance at the exact moment it is building its most ambitious commercial expansion. That destabilization would paradoxically benefit Microsoft, which holds a 27% stake, and would see its investment protected under a more constrained OpenAI structure. The weight of evidence points toward continual erosion of Microsoft's exclusive AI advantages, but this only holds if OpenAI's commercial expansion proceeds without governance disruption. If the trial surfaces damaging revelations about OpenAI's board conduct or forces a structural unwind, the clock resets. In Microsoft's deep integration, existing data center infrastructure and Copilot ecosystem would reassert as durable moats. The benchmark to watch is Azure's Wednesday's earnings figure, along with any guidance on how the amended partnership affects revenue forecasts for the next 12 months. A downgrade to Azure growth guidance would confirm the moat erosion thesis. Stable or upward guidance would suggest Microsoft has already restructured its AI revenue channels to compensate.